Welcome back to Mortgage Mondays. Last week we talked about the basics, credit, income, and down payment, the foundation. This week we're going to dig a little bit deeper. Today we're going to talk about how do you actually get approved for a home loan? Because a lot of people think that it's credit that gets them approved. No, that is not the case. It is not your credit score. You think that, if my credit is good, I'm approved. That is not the case. So we're going to dig a little bit deeper today so you know what actually gets you approved for a home loan. Today, I'm going to show you what lenders really look at when deciding if you can buy a home and why people with 700 plus credit scores still get denied. Let's jump in. So it's going to come down to approval versus pre-qualification. We need to know the difference. The difference is the big difference between approval and pre-qualification. The first thing we need to clear up is, a pre-qualification is you telling me that, you could be approved or what you can be approved by and me approving you. Whereas though an approval is what you can actually prove on paper. So when you come to us to get a pre-qualification or pre-approval, what we ask for is income documentation, asset documentation. We ask for bank statements, paycheck stubs, W-2s, and then I'm able to give you a secure approval based on that information that you could actually verify. So that is what a pre-approval is. Also, we look at your debts, we look at your spending habits, and this is where most files fall apart. So there are 3 ratios that control everything. Your credit score matters, but your ratios, they matter more. So the 3 numbers underwriters care about is debt to income, or DTI. Your debt to income is the percentage of your monthly income going towards your debt. Most people only think about their credit card payments when you say debt to income, but there are a lot of things that's included in that debt to income, like car payments, student loans, personal loans, minimum credit card payments, your child support, and your future mortgage is included as well. So you might make $5,000 a month, and that sounds great. But if 27 of that is tied up in debt and it's already committed, you may not qualify for the house you want. So number 2 is payment shock. This one surprises people. It surprises people because they're not aware that if your rent is $900 a month, you usually won't get approved for $2,300 mortgage overnight. It's going to take some time, effort, and strategy. Lenders want to see you can handle the transition smoothly and seamlessly. So even if the numbers, if they technically work, underwriters ask, is this realistic? Is this person going to be able to afford this income? The last one is residual income. It's the silent deal killer. This is what's left after your bills are paid. Not just can you afford the house, but can you still live after you've purchased the house with gas, groceries, kids, and life in general. Normally, we don't look at residual income other than VA loans, but some underwriters will want to see if you can actually afford living after you purchase this house and base their decision on it. Next, I want to talk about the bank statement trap. This one right here stops more closings than credit scores. Your bank statements, they tell a story. We look for overdrafts, gambling transactions, large deposits, cash app movements, NSF fees, and etc. We comb your bank statements with a fine-tooth comb to make sure that your spending habits are conducive with getting this loan. Because the question isn't, can you make the payment once? But the question is, can you make the payment every month, consistently and on time? Underwriters are looking for those type of things when they look at, your debt to income, your residual income, and also, if you can afford this mortgage. The biggest mistake buyers make once you apply, and we have to put this out there because it's prevalent. Once you apply, do not change your financial lifestyle, your financial life. So what that means is no new car, no new credit cards. Don't quit any jobs. We don't want you moving money around that we can't easily track or source. Definitely, we don't want you financing furniture before you've even signed or purchased the house that you want to get. Yes, people really do this during escrow, and it's important because it will kill your deal. You are being financially monitored until the day of closing. Until you sign those documents and get those keys in your hand, you are under a financial microscope. They're looking to make sure that you can afford this mortgage. So what should you do instead? If you want a smooth approval, you want to keep your income consistent. Don't move money around without asking. You want to pay your bills on time. Don't open new accounts, and ask before large deposits are made in your account. Talk to us. Talk to your loan officer before making any moves, not after, because it could kill your deal. So now that we know why people can get pre-approved and still can't close, buying a home isn't just about qualifying one day. It's about staying qualified until keys are in your hand. So next week, we're talking about how to structure your money so you can qualify for more house, which is prevalent in South Carolina, in Charleston specifically. If you want me to review your situation personally, text me or start an application. The link is below. And don't forget to subscribe so you don't miss the next Mortgage Monday. I'm excited to be here with you guys today. I'm excited to give you guys this information. And I will see you guys next week. Have a great week.